Good afternoon. This is Blake Young with TheoTrade's evening video for February 2nd, 2023. And today we're going to be talking about rate race to the top. Happy Groundhog's Day, everybody. Here we are repeating what we've done in the past. We see rate cuts and races all the way to the lowest level, hitting 0%. And now we're doing rate races to the top. A couple things I want to go through and show you today. Not only are we pulling back exactly at the top of this area that we've been watching for a peak or an edge of supply, if you want to call it that, but we're also in the overbought area. So we're struggling to move this higher, and part of the thing we're watching is whether the dollar can strengthen or not. If the dollar strengthens in comparison to other currencies, then we should see this move lower. Well, today we had rate decisions in multiple central banks. I'm going to show you a couple of things really fast on this market. This is the whole week looking at some of the key things in the US, but let's go ahead and add in the other banks. And what you'll see is that we had the Bank of England monetary report. They raised rates by 50 basis points. That was what the expectation was, but we raised the rates by 50 basis points. And the Eurozone, the European Central Bank, also did the same. So we might look at this and say, wait a minute, if the US is raising rates by only 25 basis points, then shouldn't the euro and the pound be gaining significantly more because they raised rates more? And the short answer to that is yes. We should see the pound stronger, the euro stronger, because they should have higher demand because they offer a higher interest rate. But remember, the market prices in expectations and is always forward looking. So we price in what we think, what we expect, and what we're planning going forward. So it's not just that the 50 basis point rate hike happened, it's the differential and what we expect of the differential going forward. Remember that all of these central banks were in the sub 1% level. Every single major central bank was sub 1%. Some were NERP, negative interest rate policy, and we're now all the way up to 3%, 4%, 4.25%. And yes, the US is still at the highest at it says 4.75, but we know that's between 4.5 and 4.75. So we will call the US at 4.625. Now the difference between these rates, the 4.625 and the 3%, have a significant impact on what we can expect going forward. Let's take a look really quickly, and I'll just show you the rates down here at the bottom. There you go. US is the highest interest rate of all the major currencies. The euro is at 3%, the Swiss is at 1%, and the Japanese yen is still at 0.1%. But it's still the forward look and the expectation of the future that will have the biggest impact on the strength or weakness of these currencies. To give you an example, we know when the US started raising rates. We could start with the Euro-US dollar chart, and this will become important for the housing sector, for what we can expect out of the technology sector by paying attention to the interest rates and the strength of the US dollar. When the US dollar was gaining, we can see this chart was going down. That's euro weakness, US dollar strength. So I'm using the Euro-US dollar pair to find that. But you can see that they were both about at 1% or 0% during all this time, end of 2020 and beginning of 2021. It wasn't until here that we started really seeing the interest rates rise in the US. And so watching the interest rates rise in the US and push the dollar higher and higher, or the euro lower and lower by comparison, this move was significant. If we were to measure the difference, you're going to get about a 4 times leverage on the interest rate to show you the impact of those interest rates, all other things being equal is what it comes down to. So if we were to take that look and we say that was where we're balanced, that was the low, so when we saw the breakout, we would just look at the difference there, and it's about 16%. So we reached a projected expectation of a 4% differential between the euro and the US dollar. And that's when the ECB started raising rates and the US started slowing the rate of which they were raising rates. We raised rates 4.5%, now 4.75%, and then we changed. If you look at where we're at from that time frame when they were balanced to where we're at now, we can see that that balance has dropped back down, and we're seeing about a 6% differential here. Well, what's 1/4 of 6%? It's about 1.5%. Guess what? That's exactly 4 times the differential between the European Central Bank's current rate of 3% and the US Central Bank rate of 4.625. So we're right where we want to be theoretically if we're just driving the pressure because of interest rates. Well, the fact that we rejected this area and bounced down this week, the fact that we're showing weakness in the euro is pricing in the expectation that we're not going to continue to see that 50 basis point rate hike out of the central banks, out of the Eurozone. In fact, the Bank of England even hinted that they are planning on tapering and are planning on even tapering and cutting rates possibly by the end of the year. So even though the Bank of England raised rates to 4%, they've already not only decided that they're planning on pausing, but they're probably going to be more accommodative and more dovish before the end of the year. So that's the reason why we're seeing this peak and reverse. But even though we're racing to the top, we're not seeing it improve the yield curve. We're not fixing the yield curve. In fact, the yield curve has got worse in many ways. So if we're to look at the yield curve, here's the Treasury website showing the yield curve, and the peak rate we've been seeing has been at the 6-month. If I scroll up here, you'll see that's the 6-month column. And we're looking down through here, and you see we were at 4.82 on that one. And if we were to match that up to the 10-year, because the 10-year, 7 and 10 years, what we watch for the housing market, we're looking in this area. So the differential we're getting is significant. We're seeing about a 1.28 here. And then today, you can see this dropped dramatically. The 10-year dropped really fast. So we got a worsening inverted yield curve. The short-term 6-month dropped by 0.01, and the 10-year dropped by 0.13. So we worsened the yield curve by 0.12%. That's a half of a quarter of a point. So now we're getting paid or compensated 4.79% to hold an investment for 6 months, where there's really no incentive to invest in the long term at 10 years because it's only 3.39. We get paid the difference here, 1.4% more for taking less time risk. This is significant. And this is the reason why we had the market move the way it did today. And this is the reason why we could watch for this to be an indication that we're not out of the woods. We're not done with the idea that we could see an economic slowdown. If the Eurozone and Bank of England and the US have all raised rates this week, then we are going to see a further clamping down of growth. But the reaction, the knee-jerk reaction to housing and technology going stronger is because that interest rate for the 10 years, the longer term, which is what we look at, is what the businesses borrow and homeowners borrow at the 7 and 10-year rates. We basically take 2%, add it to the 7 or the 10-year bonds, and that will give you a current mortgage rate, and you add 3% to get a current business loan. So that's kind of the things you'd be looking at in conjunction with this move. So that drop today was exciting, and it moved housing higher, it moved technology higher, it moved communications higher. But we're not done yet because we still have Apple. We still have earnings coming up for Apple and Google and others. Let's take a quick look at the 3-month sector rotation chart just so you can see how dramatic these last few days' moves have been. We are making this worse. Like I said, it's exacerbating the problem of the inverted yield curve. And who's the ones that are doing the biggest run up, the biggest strength? Communications and technology and real estate. The ones that borrow the most are the ones that are shooting through the roof. And who's doing the worst? The staples, healthcare, and energy. Energy is one of the worst. So the things that aren't heavy into borrowing, they're the ones that aren't getting the benefit of this falling 10-year rate. But remember, the falling 10-year rate is still giving us indication that we are facing an economic slowdown. Communications is one of the ones that benefit the most. You can see this gapped up, closed higher, driven primarily by Meta. Meta outperformed. It accounts for about 15% of this XLC holdings. Alphabet, Google, and Google are right behind it with Disney and Verizon and others. But this biggest move is happening with Meta, and Meta missed earnings. So we're driving this almost exclusively on hope and off really low borrowing rates. If we're to take a look at housing, I'm going to use XHB. We could use ITB or XHB. You can see it rising, rising, rising. And this is not because we're reporting earnings on the housing market. Housing market has already reported. We're rising off these really low 10-year interest rates. But the 10-year Treasury rates fell down today as the short-term rates keep rising. And again, we're inverting that yield curve worse. And it can take up to 2 years for the inverted yield curve to have the full impact. And it can also take 2 years after the inverted yield curve corrects itself before it stabilizes into a normal, traditional, healthy economy. You can see that over this last little while, we've been testing the same support level. Today, gapped down, tested the low, but recovered. And to me, this does look like it's stabilizing to confirm support. It doesn't mean that we're going to go all the way up again, but it does mean that we're finding a base. So I'm watching very, very carefully these interest rates because this will have longer-term impact to all the markets. The one area that I think we can continue to watch for bearishness would be in energy, and energy probably has a little bit more downside down to the $83 mark, where we'd find previous support, resistance all the way back through the year. 82, 83 seems like a good stabilization point for energy. Energy is definitely way down here at the lows. Healthcare, consumer staples are traditional safety plays during an economic uncertainty. We're not needing that because everybody's betting on technology and communications. But even still, even as weak as they have been, this does not look like a lot of weakness. We're not testing long-term lows. We're still stabilizing in the middle of this range. So I will be watching for the bounce in yields and a return to uptrends for healthcare and consumer staples. Based on the fact that communications rallied so much on Meta and those lower interest rates, I do think Apple's probably going to struggle to move higher after earnings in this area. They've already announced layoffs. We've already seen some slowdowns, but just be aware we've had some significant gap up, close higher despite misses in earnings. And so this area is a strong overhead area. Just be careful watching Apple going into Apple earnings tonight. The long-term view has not gotten out of view. We're still watching, and if they continue to raise rates, we can expect to see further economic slowdowns. It can just take time for that to take hold in the economy. It's not everybody instantly borrows at the higher rates. It's future borrowing that will cause a slowdown. Future borrowing that could impact long-term demand from corporations and further layoffs. So just be very, very careful with that. We are not done with this. We have not seen the peak of this market, but we also have not seen the peak of interest rates. And as long as we keep raising rates from the central banks, there will be further repercussions over time. So be very, very careful, be safe, and we'll look forward to talking to you next week.